Are you currently throwing away an extra $100 or more every single month on your mortgage? For many homeowners, especially those who put down less than 20% when they bought their house, private mortgage insurance or PMI is a silent, costly addition to their monthly payment. Imagine paying an extra $100, $200, or even $300 that doesn't go towards your principal, doesn't build equity, and isn't tax deductible for most people anymore. It's essentially a mandatory fee protecting your lender, not you, in case you default. Over the years, this can easily add up to tens of thousands of dollars you'll never see again. The good news? You can often avoid it or get rid of it much faster than you think, saving you a small fortune. But first, let's break down exactly what this hidden tax is and why it exists. PMI is a type of insurance policy that protects your mortgage lender if you stop making payments on your loan. It's generally required for conventional loans when you make a down payment of less than 20% of the home's purchase price. Think of it this way. If you put down less than 20%, the lender sees you as a higher risk because you have less equity in the property from the start. If you default and they have to foreclose and sell the home, they want to ensure they don't lose money if the sale price doesn't cover the remaining loan balance. So, they make you pay for insurance to cover that risk. It's not optional if you're in this category, and it's typically bundled into your monthly mortgage payment. But understanding its purpose is the first step to figuring out how to beat it, which we'll get into shortly. The cost of PMI isn't fixed. It varies based on several factors, primarily your loan-to-value, LTV, ratio, your credit score, and the lender's specific risk assessment. Generally, PMI costs range from about 0.3% to 1.5% of your original loan amount per year. Let's use a real example. If you buy a $350,000 home and put down 5%, $17,500, your loan amount is $332,500. If your PMI rate is 0.75% of that loan amount annually, you'd pay $2,493.75 per year, which breaks down to about $207.81 per month. That's a significant chunk of change that adds up to over $2,500 a year, and it continues until you reach a certain equity threshold. So, how can you stop this recurring drain on your wallet? The most straightforward way to avoid PMI altogether is to make a down payment of 20% or more. On that $350,000 home, that would mean putting down $70,000. While this might seem like a huge hurdle, remember that every dollar you put down not only reduces your loan amount but also eliminates PMI. If 20% is out of reach, consider a piggyback loan or October 10th 80 loan. 80% first mortgage, 10% second mortgage, and 10% down payment. This avoids PMI because the first mortgage only covers 80% of the home value. However, the second mortgage usually has a higher interest rate, so you'll need to weigh those costs carefully. There's also the option of lender-paid PMI, LPMI, where the lender pays the PMI, but they charge you a higher interest rate on your mortgage instead. You need to calculate which option is truly cheaper for you in the long run, and it's not always obvious. It's crucial to understand that PMI applies specifically to conventional loans. FHA loans, on the other hand, have their own version called Mortgage Insurance Premium, MIP. While both serve a similar purpose, there's a key difference. FHA MIP generally stays for the life of the loan if your loan-to-value, LTV, ratio was greater than or equal to 90% at origination. If your LTV was less than 90%, it can be removed after 11 years. If your down payment was less than 10%, making it much harder to remove without refinancing. For a conventional loan, PMI is removable once you hit certain equity milestones, which we'll discuss next. This distinction is critical when choosing your loan type, especially if you're putting down a smaller amount. Many first-time homebuyers gravitate towards FHA loans due to lower down payment requirements, but they often don't realize the long-term MIP implications. Weighing these options against PMI on a conventional loan is essential for your financial future. The Federal Homeowners Protection Act, HPA, of 1998 provides crucial rights for homeowners regarding PMI removal. Under this act, your lender is legally required to automatically cancel your PMI once your loan-to-value, LTV, ratio reaches 78% of the original purchase price. This means once your mortgage balance falls to 78% of the initial home value, the PMI must come off. For example, on that $350,000 home, PMI would automatically cancel when your loan balance drops to $273,000. However, you don't have to wait for the automatic cancellation. You can request cancellation sooner, once your LTV reaches 80%, provided you meet certain conditions. But what are those conditions, and how do you even get to that 80% mark faster? To request early PMI cancellation, you generally need to meet a few requirements. First, your loan-to-value ratio must reach 80% of the original appraised value of your home. Second, you must have a good payment history, meaning number 30-day late payments in the last year and number 60-day late payments in the last 2 years. Third, the lender might require a new appraisal to confirm the current market value of your home, especially if you believe its value has increased significantly. You'll need to submit a written request to your loan servicer. They will then review your account and, if everything checks out, they'll remove the PMI. But what if your home's value has actually gone up? That's where things get interesting and potentially much faster. Many homeowners overlook the power of home appreciation in removing PMI. If your home's value has increased since you bought it, you might reach that 80% LTV threshold sooner than just by paying down your principal. For example, if your $350,000 home is now worth $400,000, your 80% LTV threshold is now based on $400,000, which is $320,000. If your loan balance is already below that, you could be eligible for PMI removal. This is where a new appraisal comes in. You'll likely have to pay for it, which typically costs a few $100s, but it's a small price to pay if it removes hundreds of dollars in PMI every month. However, there's a common mistake people make when considering this option, which can cost them thousands if they're not careful. Here's a crucial mistake. Assuming a quick online valuation from Zillow or Redfin is sufficient for PMI removal. While these tools offer estimates, your lender will always require a professional appraisal from an approved appraiser to confirm your home's current market value. Don't waste your time or get your hopes up based on online estimates alone. The appraiser's job is to provide an unbiased, official valuation, which your lender will use to recalculate your LTV ratio. If the appraisal doesn't show enough equity, you'll have paid for the appraisal for nothing and still be stuck with PMI. So, before you order an appraisal, do your homework. Look at recent comparable sales in your neighborhood to get a realistic sense of your home's worth. This proactive step can save you both time and money, but what if an appraisal isn't enough? If you can't remove PMI through an appraisal or by simply paying down your loan, refinancing your mortgage is another powerful option. If current interest rates are favorable and your home has appreciated significantly, refinancing to a new loan with at least 20% equity can eliminate PMI entirely. Even if you're just short of 20% equity, you might be able to roll a small amount into the new loan if the numbers make sense, effectively resetting your LTV. However, refinancing comes with closing costs, which can range from 2% to 5% of your loan amount. You need to do the math to see if the savings from eliminating PMI outweigh these upfront costs. Is it worth paying $5,000 in closing costs to save $200 a month in PMI? It depends on how long you plan to stay in the home, which brings us to another critical consideration. Another proactive strategy is to simply prepay your principal. Every extra dollar you put towards your principal reduces your loan balance faster, accelerating the timeline to reach that 80% LTV. Even an extra $50 or $100 per month can shave years off your mortgage and get rid of PMI sooner. On a $332,500 loan with a 4% interest rate, paying an extra $100 per month could reduce your PMI period by over a year and save you thousands in interest over the life of the loan. Make sure any extra payments are explicitly applied to your principal, not just held in escrow. Contact your loan servicer to confirm their process for principal-only payments. This small habit can have a massive impact. But what if you're still confused about whether you actually have PMI? Here's a common myth. PMI is the same as property taxes or homeowners insurance. Absolutely not. While all three might be bundled into your monthly escrow payment, they serve entirely different purposes. Property taxes go to your local government to fund services like schools and roads. Homeowners insurance protects your home from damage and liability. PMI, as we've discussed, solely protects the lender. It's not an asset for you. It's a cost. Many homeowners see one lump sum payment and don't differentiate these components, which is a huge mistake because only one of them is removable. Always review your monthly mortgage statement carefully. PMI will be itemized separately, usually as MIP or PMI. If you don't see it, you likely don't have it, but it's always worth confirming with your loan servicer to be absolutely sure. Knowing exactly what you're paying for is the first step to taking control. So, the biggest takeaway is this: PMI is not a permanent fixture on your mortgage, and you have several powerful tools to either avoid it or get rid of it. Take the time to review your mortgage statement, understand your current loan-to-value ratio, and explore the options we've covered today. If you're wondering what happens to your interest rate if you try to refinance now, watch our video on understanding today's mortgage rates next. And if you found this helpful, please consider subscribing for more insights into navigating the U.S. real estate market.